Hi, I'm Pattu from freefincal. Today let's take a look at the NFO from ICICI, the Nifty Low Volatility 30 ETF Fund of Fund. So this is basically a fund of fund that will be investing in the AMC's own ETF, the Nifty Low Volatility 30, and that will be tracking the Nifty 100 Low Volatility 30 Index, that is 30 stocks with the lowest volatility in the large cap universe of Nifty 100. I have been talking about the low volatility theme for a long time now, and many regular readers would know that I pick stocks using low volatility as one of the key ideas, and therefore it makes sense for me to get excited about this fund of fund. But I really was not excited to begin with, and when I looked closer, I think I am right. So let's take a look at why I think so. So this index will basically take a look at stocks that have the lowest price volatility over the last year, and it will give the highest weight to the lowest, the stock with the lowest volatility. But if the stock has got a liquidity less than that of the Nifty 50 stocks, then its weight will be capped at 3%. And what happens is, as a result of this rule, the index more or less behaves like an equal weight index. You can see that these are the 30 stocks that are currently part of the ICICI Low Volatility 30 ETF. You can see it's more or less between 2 to 3, 4%. There's nothing that sticks out. All of them are more or less equal weight. And if you look at the sectoral history of the fund, the brown is the IT stocks. It's got about 15 to 20% of IT stocks at all times, and 10 to 15-20% of FMCG stocks. So it's been heavy on IT and FMCG most of the time, and which is different from the way Nifty is constructed, because Nifty can get heavy on finance stocks and so on from time to time. So the ETF was launched in July 2017. The AUM is only 272 crores. The expense ratio is of the ETF itself is very high. It's 0.42%. And on top of that, the fund of fund could have an ETF of another at least 0.1%. It can even be more. So that means that if you compare it with the Sensex or a Nifty fund, the fund of fund or the ETF has to perform 4 or 5 times more above these expenses to beat the index on an absolute basis. Now, if you ask low volatility, does low volatility investing work? Then there are two parts to this question, or to the answer, I should say. One is, as a concept, as we shall see below, low volatility investing works very well. There's no problem about the concept. But in the real world, if you add the expenses of the ETF, the price NAV fluctuations of the ETF, then the fund of fund which will be buying the price of the ETF, then there is an expense ratio for the fund of fund, all these practical aspects are added in, then it becomes a kind of a problem, and the answer becomes a little unknown. So usually in an ETF, what happens is there is a price, that is, the unit holders do not buy at now. They have to buy and sell to other unit holders. So there is a market price, and this market price will fluctuate and can deviate significantly from the NAV. Now the AMC is supposed to appoint an authorized participant who can use arbitrage and benefit from this price NAV deviations, and they will benefit, and because of their profit, they will bring the price close to the NAV. If the price goes above the NAV, they will bring it down or below. I have explained this in detail in another video. I don't want to get into it now here. So they are supposed to appoint this AP and make sure they are active. Of course, they have appointed the authorized participant theoretically for many ETFs, but they are really not active, as you can see from the in reality how the price always is found below or above the NAV for extended amounts of time. The most dramatic example of this is in the case of the Motilal Oswal Nasdaq 100 ETF. What you see here is the price minus NAV divided by NAV. So that's the price NAV deviation. You can see the violent fluctuations of the blue dots, and in November 2018 Motilal Oswal introduced the fund of fund for this ETF, and immediately there was a rush of AUM into this fund, and if I recall, Motilal Oswal reduced the TER of the ETF, and they from that point onwards they made sure the price NAV fluctuations were kind of small. In fact, even during the Corona crisis they were quite small. But this is something that I do not appreciate. I mean, whether the AUM is 5 crores or 500 crores or 5,000 crores or whatever it is, the authorized participant should be actively reducing these deviations, and that doesn't happen in reality. Only when the AMC senses that people are interested in a product and there is a lot of AUM coming into the product, they take the trouble of reducing the price NAV deviations, and this is the most dramatic example I've seen in the Indian context. Now the orange dots are the price NAV deviations of the low volatility 30 ETF. Relatively they are okay, but that's of course you must recognize that the price NAV deviations for even for a well managed Nasdaq 100 ETF in India will be high, because the trading takes place in a different time zone, the currency is different, and so on. So relatively speaking, ICICI has done well, but notice the vertical rectangle, that's the huge deviations during the March 2020 crash, and you can see how the price, which is the orange line, fluctuated from the NAV for the ETF. So this is a problem that has to be sorted out. Maybe the AUM going into the fund will sort it out in future, but what happens as a result of this is since July 2017, that is the inception of the ICICI ETF, the Nifty 100 total returns index has moved on an absolute scale by 55.75%. That's the absolute change. The Nifty 100 low volatility 30 index has moved up by 60.32%. The index total returns has bet Nifty 100, but the Nifty 50 total returns index has gone up by about 60.08%, and the UTI Nifty 50 index fund, which has got a expense ratio of about 0.1% or so, that has moved up by 58.22%, but because of the 0.42% expense ratio and because of the price NAV fluctuations, the ICICI low volatility 30 ETF has only moved up by 58.18%. So it has lost quite a bit because of these fluctuations, and this is what will happen in real life. Because of the fluctuations, because of the expense ratio, you will not get that as much benefit as one should, and this is something that you should be aware of. And if you actually look at the since inception data here, I have plotted the price of the ETF, the ICICI Nifty Index Fund Direct Plan, Nifty 100, Nifty 50, all of them, they are in different colors, but it doesn't matter, all of them look the same. So although you can say that low volatility as a concept works, in real life over almost 4 years, it has not been able to beat the Nifty. So this is purely because of expenses for the window I have shown you. So that's something that you have to be aware of. But as an idea, I have plotted from 1994 10-year returns of the Morgan Stanley index, the MSCI low volatility minimum volatility index, which is in yellow, the MSCI large cap index in brown, and pink is the large and mid cap index. And you can see the yellow line is more or less above the yellow line for a significant amounts of time. Of course, not always, but so it does work even on an absolute level. But the benefit of low volatility is you are guaranteed with a significantly lower standard deviation. You can see there is a big drop in standard deviation because of the low volatility. And if you look at the drawdown, that is the fall from the peak, the low volatility index, the black line, has done quite well compared to the other two indices. Again, these are all the MSCI indices. So in terms of absolute returns or even in terms of risk adjusted returns, the low volatility concept works. But in real life, when you add the ETF demand supply fluctuations and the expense ratio of the ETF, the expense ratio of the fund of fund and so on, things can be quite different. In India also, you can see that the Nifty 100 low volatility 30 index, the yellow line, has comfortably bet the Nifty 100 for the short amount of history that we have. For over a period of 10 years, it has a rolling basis, it has bet, and there's no problem. Again, this is the standard deviation which is low and so on. So the drawdown is also reasonably good. So this is the main problem. So my suggestion is, please do not rush to invest in this ETF, in the fund of fund. Please wait and see how the expense ratio changes, how the AUM of the fund of fund changes, and wait for a year, maybe even more, and then we can take a call whether it makes sense to invest or not. As of now, I would say I'm not terribly excited, and I would suggest that to wait and watch.